All right, so I want to do a quick update video on my mock $1 million portfolio. I did make the first official move ever since making this. I think it was back in May or June. And honestly, I probably should have did this sooner, but I kind of had cold feet, for lack of a better way of putting it. But I made the move, and the move was adding Amphenol, right? This is a company that I made a video on recently. I really like it. I got in at about 81.5. And again, the stock that I swapped it out with was Alexandria Real Estate. And I still do like this company to a degree, but something that I think is quite clear when it comes to this REIT and a lot of other REITs is rates are going to be higher for longer than we expected. And it has hit this company particularly hard, right? I mean, if we look year to date here, this company's down about 31%, which is crazy, right? But I bought it. I would have bought it. It would have been maybe one. I think it was in the 110s, between maybe 115 roughly. So I mean, let's just say it's at 114. I was down about 13%, 12 or 13%. So again, nothing crazy. I mean, you do have a 5% dividend right now. FFO yield is 9%. So again, the dividend is still covered fairly easily. So that's not something that I was concerned about. What I was concerned about is rates staying higher for longer, right? And this is a company that funds a lot of life sciences, kind of biotech companies, right? And again, when rates are low and times are good, this is going to be a really, really good performer. But I think over the next year or two, times might not be quite as good. Rates definitely are going to be high, right? I mean, barring a major crash, we're not going to see rates go down anything, maybe at all, but definitely not anything significant, right? So I would wait until we see a Fed pivot. That's when I would get into this company. So this is definitely a company I will get into again at some point. Will I add it to this particular portfolio? Not 100% sure, but that is my reasoning behind that. Kind of a couple different reasons, right? Again, we've seen a lot of these other REITs, like Realty Income comes to mind, that have gotten hit very hard recently. And again, like I said, I think we're going to see higher rates definitely for possibly all of 2024, right? I mean, honestly, I think the odds right now are we're not going to see a rate cut until late 2024, right? Late 2024, right? So we're talking about a year from now. And it's like maybe 25, 50 basis points. So again, unless we see a major crash, rates are not going down anything significant. And that's something that I think is concerning for a company like this. Again, I still like the company. Like I said, again, you got a 5% dividend that I think is covered relatively easy. They're growing fairly nice, right? I mean, they're growing that dividend 6% a year still. There have been some cuts in the past, but again, over the long run, it still has gone up. So, but again, and look at this chart here too. Look at this chart. Again, it outperformed the S&P for the longest time, but then over basically since March of this year, it's just gone down a lot, right? So that is ARE. If we look at Amphenol, again, I did make a video recently about this company. Let's touch on it again briefly. Again, very, very good company. Again, 1% dividend, but again, they're growing that 12.8% per year. Payout ratio is only 26%. So they're going to be able to keep growing that dividend very nicely, right? Again, if you go back 10 years, you have a dividend yield on cost. It's over 4%. Again, this is a company that's always easily outperformed the S&P. I mean, we go back 10 years, they've almost doubled the S&P. Let's go back 5 years and check and see here. Right, I mean, if we go back 5 years, we're looking at a company that still beat the S&P by 31%, right? So again, that's one of the many reasons to like it. If we check out the information here, growth, again, it's not great. It's still solid. Financial health, current ratio 2.3, that's good. Management's doing a phenomenal job. The profitability is pretty good as well. It's not great, but it's pretty good. But again, price of free cash flow, 12% below its 5-year average. PE is below. I mean, the price of sales is a little above, but again, a price of sales of 4 for a company that's beating the S&P rather easily, again, I think that's still a good deal, right? Again, if we look at its historical valuations here, this is another thing that I think is important to always keep an eye on. Again, the average price to free cash flow is 28.6. Latest 27.1. Average price to operating cash flow 21.4. Current 21.3. Right? So again, if anything, this company is trading at a discount right now. Right? So again, that's one of the many reasons I like it. Again, another very important metric that you want to keep an eye on that I brought up with Lam Research, and I have looked at before, but I think it's very important, is the compounded growth rate to that operating cash flow is 13%. Right, that's solid. That's solid. It's not great, but that's still pretty good. If we look at the actual, as far as the share price returns go, we're talking 2.6% and 2.3%. Right, so the clear majority of that share price growth over time has been due to actual tangible cash flow getting better. Again, this is something that you always want to be concerned about as an investor, is if share price returns are being driven by people simply paying more they're paying a higher valuation, right? That's something that should be concerning as an investor, because the fundamentals are not getting better, but again, why are people paying more for that? That's something that should be concerning for you, right? Especially in a higher rate environment, right? In a low rate environment, okay, maybe you could argue against that, but in a higher rate environment, I would be very concerned. So again, I wanted to make a quick video going over that change. Again, I will be keeping a closer eye on this going forward, because honestly, for the first 3 or 4 months of this, I kind of just made it and forgot about it. Now I'm going to be watching it closer. Again, I'm not going to be trading in and out constantly, because, again, that's not the kind of investor I am. But I will be keeping a closer eye on things. So again, if you like the video, please comment, like, subscribe, all that good stuff, and stay tuned for more.